So we're sitting here on the deck at Lean's Lodge on Labor Day weekend. I'm David Kotok, and this is a longtime good friend, Christopher Whalen. And we'll cut to the chase because we've had a great day fishing. We've caught fish.
Yes,
we've enjoyed the ambience.
many fish.
So and the world knows about this ambience up here.
Well, we're going to tell them anyway.
Yeah. So cutting to where we are now, you have expertise in banks, banking, credit, mortgages. You've been doing it professionally for a long time.
Yes.
We have 17 trillion of negative interest rate debt in Europe. Somebody in Denmark can buy a house with a negative interest rate mortgage.
Yeah.
Credit problems coming to the U.S. Maybe.
Maybe.
What happens if these interest rates in the U.S. go lower? Some of our friends are saying we should follow the interest rates down to negative rates. What do you see?
I'm not that worried about the United States. I'm very concerned about the rest of the world, especially Europe and Asia. The demographics are driving this mostly. And I think also that 10 years later, the crisis continues. The central bankers have pretended that they can solve the problem, but they can't. The problem is too much debt and the related deflation. So, you know, I think the U.S. market is very dynamic. It's largely a non-bank market. And so that's the big difference between the U.S. and the rest of the world. You're not going to see negative mortgages in the U.S. You can't. It doesn't work.
What would happen if there were an attempt to have them?
The investors would say no.
Well, so you have confidence in our capital markets.
Yes.
Because we're not bank dependent the way Europe is.
Correct. I mean, after the crisis, most of the non-bank markets for auto loans and credit cards and mortgages fixed themselves. They didn't need the government to come and help them. In Europe, almost all financing goes through banks. So it's easy for a central banker to force those markets negative. Whereas in our market, you'd have to go convince PIMCO and BlackRock and all the rest of them to accept an asset where they are essentially losing money. And they wouldn't do that. They can't.
So where does the European thing go? We're in a race to lower and lower negative interest rates.
Yes.
We now have some sovereign debt negative interest rates approaching minus 1%.
Correct.
A full 100 basis points minus. What do you see? How does this play?
Eventually, the Europeans are going to have to accept that this is not an answer. And they are going to have to do the next thing, which is debt restructuring. And the central bankers are terrified of this because they think it will stoke deflation. But that's kind of what we have now. So why don't we step back for a moment, tell Christine Lagarde and all the rest of these bureaucrats, no, this is not an appropriate answer, particularly if you're looking for growth. You see, negative interest rates are a tax. They are reducing the capital stock of the private sector. How is this helpful?
Well, that's a good finish. You mentioned Christine Lagarde.
Yes.
And we're having this delicious closing beverage here at Lean's Lodge. So what are we drinking?
To a wonderful future and more fishing.
And this is?
This is a beautiful French Bordeaux.
Thank you, Christopher.
Thank you, David.
Yes.